This week on Wealth Track, keeping your eye on the ball to win the investment game. Research maven James Bianco is watching inflation expectations, while fund manager Thyra Zerhusen, one of smart money's world's greatest investors, is tracking mid-cap stocks. They trade strategies and ideas next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter, and the Dreamin Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. We are delighted to be taping at the Museum of American Finance in the heart of Wall Street. It is the only museum devoted to the history of finance, the foundation of our capitalist system. Now, one of the lessons we learned from the financial crisis and its aftermath is that macro matters. Policy decisions and global events can affect the financial well-being of businesses and individuals, both short and long term. And as a result, we've been paying a great deal of attention in recent weeks to Federal Reserve policy, which is slowly transitioning, and we emphasize the word slowly, from the most accommodative it's ever been to slightly less stimulative. As guest James Bianco will explain in a few minutes, June 30th, when the Fed's quantitative easing 2 program of buying Treasury bonds is set to expire, could be the most important day in the market this year. On the other hand, another emphasis of ours on Wealth Track is the importance of good old-fashioned security analysis in delivering superior multi-year performance. Our other guest, mid-cap mutual fund star Thyra Zerhusen, will explain how she picks the company she does in her 4-star rated Aston Fairpointe Mid Cap Fund. Meanwhile, here's what I have relearned from the markets recently. First, if it looks like a bubble and feels like one, it is one. Silver's flash crash and stabilization at a significantly lower level proves the point that no matter how compelling the reasons for buying silver, every investment has a price at which it doesn't make sense. The fact that commodities exchange officials have raised the cost of buying silver on margin for speculators by 84% certainly hasn't helped. Second, there is a growing sense of complacency on Wall Street. The bulls are out in force, despite the doubling of stock market since the March 2009 lows. Yes, corporate earnings are still improving, but as Jim Bianco will point out, the fundamentals might not quite justify the price appreciation. Third, psychology can change behavior in a heartbeat. Reports that some prominent investors were selling gold and silver hurt those markets. Word that the Navy SEALs had dispatched Osama bin Laden provided an instant boost to America's optimism and confidence in its capabilities. Well, this week's guests pay attention to psychology, price, and fundamentals. Thyra Zerhusen, named one of the world's greatest investors by Smart Money magazine, has run a top-performing mid-cap fund since 1999. Recently, she and her team launched their own firm, Fairpointe Capital, where they will continue to manage the fund under the name Aston Fairpointe Mid Cap Fund. Jim Bianco heads up the independent research firm that carries his name. Bianco Research has been turning out unique, current, and historical analysis on interest rates, money flows, bonds, commodities, and other markets for more than 2 decades, and is considered a must-read by many portfolio managers and traders. I started by asking Jim why he believes the market is now all about inflation expectations.
Because Chairman Bernanke told us they matter. He mentioned it 21 times in his press conference last month, and he said it repeatedly. He said it's going to be the key measure that's going to tell them whether it's time to tighten, whether or not there will be a QE3, whether or not QE2 has been successful if we get too much inflation by that measure or too little.
So June 30th, which is when the quantitative easing 2 ends, you are also saying that you think that that could be the biggest day of the market this year. Why is that?
It could be a significant date because if you believe the market has been propped up by all of the quantitative easing, the $600 billion worth of buying, it's up about 28% since last August. Then when it ends next month, it's going to be an interesting thing to see what happens. Does the market correct? Does the market show that quantitative easing maybe wasn't an issue at all and it just continues on? Do we get talk of QE3? Do we get talk of tightening? All of those outcomes could lead to very different paths for the market after June 30th. So it's not like July 1st is going to be the big thing, but after June 30th, there's big paths that the market could go on that can lead to very different outcomes for the second half of the year.
Thyra, does any of this matter to you running the Fairpointe Mid Cap Fund?
Well, my outlook is more like 5 to 7 years. So I buy stocks today that, I'm asking myself, where could the stock be 2, 3 years from now, 4 years? My average holding period is 5 years. And I have many companies in the mid-cap space that also do very well internationally. Like BorgWarner, for instance, 65% of their business is outside the United States. Akamai is worldwide. They accelerate the internet applications. And so I think they should do well.
So does anything matter on the macro level as far as you're concerned?
Of course, it matters. It's
right.
the background, and you have to be careful of valuations, PE to growth rates. Would the growth be impacted? And for certain stocks that are in the construction business, public works, constructions, engineering, that it should make a difference.
Right.
But in many companies that we have, it probably wouldn't make a big difference.
So it's on a case by case.
We have fundamental bottom up, so it's case by case, yeah.
So it's so interesting because Jim at Bianco Research is watching what the Fed obviously is doing very closely, and Jim, it seems that Fed policy matters more now. Not than it has at any time in the past, but it seems to have become more pronounced and more significant over the last couple of years. Is it because the Fed has expanded its balance sheet so much? Is it because they have been so intrusive in the Treasury markets that they've kept 0% interest rates for such a prolonged period of time? Is that why, and what kind of an impact has that had on the market? Has it been a prop for the markets, do you think?
Yeah, well, exactly. For the first half of your question, it has been very important because it's so extreme. Prior to 2008, Fed policy could be described as arguing about shades of gray. But since 2008, it's been arguing about black and white because the Fed has taken such extraordinary actions and done things that people never thought even 2 or 3 years ago that a developed country central bank would do. It's more like what Zimbabwe would do rather than what you would expect the United States Federal Reserve to be doing right now. So it has had a big effect. I think its most pronounced effect has been in the way that the stock market has been trading. The correlation of a large cap stock to the index itself is the highest it's ever been. And we got data on this back to 1926. The average stock in the S&P 500 is 80% correlated to the S&P 500. In simple terms, that means every stock looks like the S&P 500 within that index. Now, why is that? We've argued that there's a number of overarching macro themes that have been dominating the market, especially in the large cap space, to make them all look alike. And it's made stock picking within that space much more difficult now than it's been in previous years because everything goes up and down together.
Not so, right, in the mid-cap space?
No, not at all. If you look at mid-cap stocks and the mid-cap index, the mid-cap index is up 10, 11% for the last 10, 15 years, versus if you had invested in large-cap stocks, you barely have any returns.
And is there a wide dispersion of performance and returns in the mid-cap space as well? So does stock picking matter?
Stock picking matters.
A tremendous amount?
Yeah.
So let me ask you, Thyra, because Smart Money has called you one of the world's greatest investors. You have a terrific long-term track record. And so how do you choose your stocks? I mean, how do you explain your performance, versus 95% of your peers?
Okay, it's bottom up, and we sit down with management. And because our average holding period is 5 years or longer, we know the companies quite well. We know management well. And if there are, short-term declines, and we think it's a short-term problem, we would add to positions. And in some cases, we wait for the opportunity that the company has a short-term hiccup to either start positions or add to positions. We also have a lot of companies that produce businesses, services or products that make their clients more productive, that are must-have products, that their clients could not do without these products.
So so that's something that you look
Yeah.
for. What are some of the companies that have must-have products?
One really good example, and we have had the stock since 2002, is BorgWarner. They're a supplier to the automobile companies.
No, automatically there I'm saying, well, then they can't be a good business.
Yeah, but because they make products that make the autos more energy efficient, turbochargers for diesel engines. Dualtronic is between stick shift and automatic. Again, it's a product that makes the autos more energy efficient. So they are huge now internationally. Over 65% of their business, big in Asia, supplying the Chinese automobile companies, Indian automobile companies, Korean. The company just reported recently earnings and revenues, and they were up, strong double digit.
Jim, let me ask you about stock market valuations, because you mentioned the effect that the Fed has had on large cap stocks, especially in the S&P 500, and kind of propping up the values of stocks. Do the fundamentals that you're seeing, which I know you also track, do the corporate earnings, for instance, do they justify or how much of the stock rise do they justify since the Jackson Hole speech in August of last year?
It's hard to say, because what's happened with the fundamentals, if you look at now consensus forecasts of earnings looking out 12 months or so, something interesting over the last 5 years, the divergence between what the analysts have guessed and what it actually turns out to be has gotten worse at any point in the last 30 years. So if you wanted to ask a simple question, when has been the worst time for analysts to predict earnings in the last 30 years? It's been right now. They've been doing worse now than they've ever done. So
so wait a minute, let me just ask you. So in other words, the analysts are saying one thing. They're saying these are our earnings expectations, and they're off the mark more than they've ever been?
More than they've ever been. For instance, in 2008, in the beginning of 2008, the consensus forecast for the S&P 500 was about $105 a share. Now, if they miss by $5 or $10 a share, that's a big deal. It came in at 50. They missed by $55 a share.
Why?
And it was the Great Recession. They just completely missed the Great Recession coming, and they just completely missed the big write-downs in the financial sector. So there's a bit of a discount in the earnings numbers. Yes, you can nominally look at the earnings numbers and say whatever they're projecting for 12 months out makes the stock market look attractive, provided, of course, that projection is worth anything in 12 months. And what we found in the last year or so, or last couple of years, is they're fine, the analyst earnings expectations, until the economy turns, and then they're off wildly. But that's really when you need them to be right, is when the economy's off. So that's where I think that there's a bit of a discount put into the earnings expectation. So when people say, well, the stock market is trading at a 12 or a 13 PE relative to forward earnings, that's true, but people don't necessarily completely buy in that those earnings numbers in a year are going to be what everybody says. We've had too much recent experience where it's been way off.
So to my initial question, do you think the stock market is reflecting the fundamentals of the earnings story, either on the upside or the downside, or what's your take?
Not totally. I think since the Jackson Hole speech, if we use that as a marker,
right.
Even the Fed uses that as a marker. It's become like one of the more important dates in history now. The stock market's up 28%. I'd say that the earnings, you could comfortably say maybe half to 2/3 of that rally was supported by the earnings. That means a third to half of the rally is QE2. That means that the market could be vulnerable to a 10 or 15% correction should the market believe QE2 is over, there will not be a QE3. Now, I think the market holds out hope that there might be a QE3.
Do you think?
Yeah, just like we had a year ago. We had QE1 end a year ago, and everybody said there will not be a QE2. And we got it 3 months later. And so the market's belief is it's kind of like a put option. If everything's okay on July 1st, they won't announce a QE2 or 3. But if we have a correction, if we have the economy continue to slow, and we've seen some slowing in it recently, that could be on the table. And so the market is not completely devoid of the idea that there won't be a QE3. I think it's been somewhat supportive of stocks. Now that goes away either because inflation comes up too much or the Fed adamantly says they will never ever do it again. I think the market could be vulnerable to somewhat of a correction.
Thyra, do you pay any attention to analyst expectations?
Of course, yeah, I do. And I look at the consensus expectations and I listen to the conference calls and sort of make adjustments. And I try to fine-tune the analyst expectations and then make a sort of a educated guess, can they do better or worse than, and why? And in some cases, especially last year, you had a lot of healthcare related stocks. Varian Medical is one of our holdings, and people were quite, negative on these healthcare stocks. But there again, you have a substantial amount of their business outside the United States. And the outside, revenues for those outside United States areas were quite good.
Another factor in the mid-cap space, which you had mentioned to me earlier, was that there are a lot of takeovers in the mid-cap space.
Right.
So
that's
talk
right.
to me a little bit about that and how that can definitely help the performance in mid-cap stocks.
It did. And during the 12 years that I've managed the fund, we had more than our fair share in takeovers compared with the S&P 400. And the S&P 400 had more than the S&P 500. It makes sense because mid-cap stocks, large caps, to keep their growth or add to their growth, they have to have acquisitions in many cases. And so they buy good, focused mid-cap stocks that can help their growth outlook.
I know that there have been some projections on Wall Street that we're going to see more M&A. I mean, they're talking about all of these shareholder-enhancing type of activities. So are you expecting that the takeovers will, continue and possibly increase in the next year or two?
I expect it because, during the last few years there was hardly any, and now balance sheets are fairly good, and so it's a possibility of more takeovers. And we just recently had one that we tendered, and that was Beckman. BEC. And so it's starting again. And historically, for the 12 years, on the average, we had a couple of takeovers every year. And we had a lot in 2007. And
I have to ask you about a couple of holdings you have that are, I would say they're contrarian holdings, and that's probably being kind. That's what you're known for that as well.
Yeah.
But the New York Times and McGraw-Hill, which of course those of us who have our iPads, not me, but those of us who have our iPads and whatnot are saying to me that is so passé. They're an old industry. Why the New York Times and why McGraw-Hill? What's the appeal there?
New York Times, the appeal is that contrary to what most people believe, people still read the New York Times. And their readership, core readers are subscribers that have been subscribers for 2.5 years or longer. And they have grown from 600,000 to over 800,000 plus in the last 10 years.
Oh.
So the readership is fine. The problem was advertising, and the problem was also moving to more electronic reading. And of course, you can read the New York Times on your iPad. You can read it on your iPhone.
And so that was a good business move on their part. It's actually bringing us, the rest of the population into the readership pool.
So in the content, it's still very respectable content. Their NewYorkTimes.com, the page, they get very interesting, advertising revenues for that, and it's read and respected, worldwide.
McGraw-Hill?
McGraw-Hill, I had, owned it and followed it. I started out as a media analyst, so I knew the company relatively well.
Right.
And a year and a half ago, I read Barron's, and lo and behold, McGraw-Hill is sort of in my mid-cap space. And it had to do with the S&P business and the rating business. And what interested me
the
is
stock had fallen,
it had
so that
fallen
it was in the mid-cap
quite
space.
a bit, quite a bit. And then 70% of their operating income comes from financial services. With the exchange-traded funds, there's a whole big growing business there. And the company looked attractive at the multiple and has done quite well.
And still looks attractive to you.
Yep.
Yep.
I still have it.
Jim, I have to get back to these earnings expectations, and this is something that has always intrigued me, is that whenever a company reports, if it's a large company and it's well followed on Wall Street, it always says it meets or beats or underperforms street expectations.
Yes.
Do they matter, street expectations?
No, it doesn't matter at all because, first of all, the last time that a majority of S&P 500 companies actually did not meet expectations was in 1998. That was over 50 quarters ago. So they've been above 50% meeting expectations or more for 50 straight quarters. For the last 10 quarters, it's been about 78%. To be blunt about it, it's a rigged game.
Right.
The investor relations departments will call the analysts and tell them for the next quarter, we're talking about now, 35 cents. The company will report 40. So then all of the financial media can say that these guys did great. They beat expectations and give them all of the accolades they want. And I think that the street has long figured out that this is kind of a rigged game, and they've moved on to looking at revenues as a better measure of what companies are doing. But now even those numbers are starting to come in at 75% above expectations, and when they never did before until about 3 quarters ago. So you have to wonder, is it because the economy's suddenly gotten great that everybody's got revenues, or are we playing, have we moved the game on now to revenues? So there's nothing illegal about it. There's nothing wrong with it, because it's all about companies reporting what they were going to do, and analysts are kind of willingly playing along with the companies to not try and get the number right, but try and get on the good side of the company so that they can continue to keep their relationships with them. And it results in these numbers that every quarter, every 3 months, without fail, we always run out that 75% of the companies beat the earnings numbers, as if it's some revelation that we should be all stop and look at and say, that changes my view about the market, forgetting that that pretty much happens every single quarter is what happens.
All right. So the emphasis that we hear a lot of times in the news on earnings estimates and whether they meet or beat, does it matter to you around earnings season? What do you believe?
It definitely matters to me.
Yeah.
And of course, in some cases, they manage the earnings.
Right.
And they sort of, guide you a little lower than they can actually do.
Right. So
but the outlook is important as well. In the margins. Did they beat margins? Are they more profitable? So it's a whole combination.
Right. At the end of every Wealth Track, we ask each of you for one investment that we should all own some of in a long-term diversified portfolio. So, Thyra, what would yours be? And I think at one point you were thinking about Akamai Technologies, but...
Yeah, I think maybe Akamai is a really important technology for moving, more business on the internet.
What do they do? What does Akamai Technologies do?
They accelerate applications over the internet. So, instance, Amazon, when they have peak demand around Christmas time, instead of building their own systems with servers and software, they can outsource peak demand to Akamai. Or CNN, 9/11, everybody wanted to see the news, what happened, and CNN broke down. Later, they became Akamized. And so now, Akamai handles this problem that, many people can see this simultaneously, or the soccer games, or the Obama inauguration.
Or the Bin Laden, right, assassination.
So you can see that, and Akamai can help, solve this problem, and a lot of people want to see this simultaneously. So that's Akamai, and their revenue growth rate is sort of 19-20%, and the PE multiple is close to that. So at this point in time, I think it's not bad if you're long-term.
Long-term,
that's
key.
Not necessarily for the next quarter. Can they have another quarter that's maybe not quite better than expected? That's possible.
Right. No, but we try to think, we're thinking long-term here,
It's
at least,
longer term,
5 years. And I don't think Jim can even think of 5 years, but if you had to pick one, Jim, what would you have us own some of in a long-term diversified portfolio?
Maybe the inverse of Akamai, if that's the new world, I'll go Old Testament and say gold and silver at that point. Gold and silver, if you can own it in the ETF, in a tax-free account, because there is a collectibles tax on it. So if you can own it in an IRA or 401k, that would be the place to do it to avoid that extra tax penalty that they have. Why gold and silver? Consider them the anti-financial markets. People worry about the dollar. A lot of investors, like Thyra, is invested overseas because there's probably an embedded belief that the dollar will not perform as well as they can. So how do people get their money out of the financial system? They really can't. The closest you can do it, though, is gold and silver. So at some point, everybody should have some gold and silver in their account. Now, it is very volatile right now. You've seen in recent weeks that silver could move 10% in a few days. That's to be expected when it's doubled in the last 5 months or so, that you get that kind of volatility. But I still think that over time, they will still prove to be what they've always been, a store of value. And they have been, especially in the case of gold over the last several years. And I still think they will. Now, I wouldn't recommend that you put a big position on it. I would recommend you understand the volatility that they've recently had so that if you see more of that volatility, it doesn't surprise you. But gold and silver, go Old Testament might be a good way to do for a small part of your portfolio.
So, Thyra, I know you have a lot of money invested in your own fund, in the Fairpointe Capital. So, but do you own any gold or silver?
I brought some.
You prefer to wear it and carry it with you. That's right. So we have the old world and the new world uses of gold and silver.
Okay.
So Thyra Zerhusen, thank you so much for joining us on Wealth Track. And Jim Bianco from Bianco Research, thank you so much for joining us as well.
Thank you.
Next week, we're traveling to the new world of investing outside of the United States with Morningstar's International Stock Fund Manager of the Decade. I'll sit down with Oakmark International's great investor, David Harrow. We'll have an in-depth discussion of how he invests and where he is finding unloved bargains today. Meanwhile, to see this program again, please go to our website, wealthtrack.com, for a podcast or streaming video. And while you're there, check out Wealth Track Extra, where you can find complete extended interviews with recent guests. Thank you for taking the time to visit with us. Make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Research Affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter, and the Dreamin' Foundation.